Target Corporation stock, ticker symbol TGT, one of the bigger retailers in the US which is growing in market share every year. But Target is also known for the dividends. They increased the dividends for 53 years in a row, which is really impressive. But is this company also a buy right now based on the fundamentals? In this video I will show you everything you need to know about Target stock. I will show you what they do and I will show you my fundamental analysis to see if TGT stock is a buy or not. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analyses every week, where I will tell you everything you need to know about the stock market. So, with almost 2,000 stores, Target is a leading American general merchandise retailer, offering a variety of products across several categories. Most of Target's stores are large, averaging more than 125,000 square feet. The company has a significant e-commerce presence, deriving around 90% of the sales from the channel, up from 9% in fiscal 2019, before the pandemic. In addition to its namesake stores, Target owns Shipt, an online same-day delivery platform. Target has 5 main categories. Beauty and household, representing 26% of the total revenue. Food and beverage, representing 20% of the total revenue. Home furnishing and decor, representing 90% of the total revenue. Hard lines, 80% of the total revenue. And at last but not least, apparel and accessories at 70% of the total revenue. Of course, companies like Target did benefit a lot from the lockdown period, and I think it's very important to keep that in mind when evaluating this stock. An important metric for me are the comparable sales growth, revenue per square feet, and the total number of stores. It's very easy to generate more revenue or to gain more market share by just opening a new store, but you also want the existing stores to grow. So let's start with the comparable sales growth. Before the lockdown periods, comparable sales growth was at a minimum growth between 1 and 5% each year. In 2020 it was almost at 20% and in 2021 it was almost at 13%, which is of course significantly higher. Personally, I think this number will go down each year, which is not a bad thing necessarily. But I think I would like to see this number at least at 4 to 5%. So whenever it goes to 4% or lower, I think this is something to worry about. But for now, it's looking great. Next are the revenue per square feet, which is growing at a nice and steady pace, so that's comforting me a lot. The total number of stores are also growing, which is also a good thing. It looks steady and consistent, so that's also comfort me a lot. Another interesting thing is the sales shares of the stores and online sales channel. In 2021, online was representing 80% of the total revenue and the stores were representing 81%. Online is up from 9% in 2019 to almost 19% in 2021, which is a big increase, and this number will only go up even more. In the end, margins could go up even more when people are more ordering online. So now that we know more about Target Corporation, it's time to check the historical stock price versus the competitors. I decided to include the S&P 500, Dollar General, Costco, Amazon and Dollar Tree. On the 5-year chart we see that Target is up more than 300% in stock price versus the S&P 500 only being up 73%, meaning you've beaten the S&P 500 big time with owning Target stock over the past 5 years. Dollar General is up 270%, Costco 206%, Amazon 150% and Dollar Tree is up almost 100%. So Target stock is definitely the winner here. On the 1-year chart we see that Target is up almost 9% versus the S&P 500 being flat. Dollar General is up 8%, Amazon is down almost 30% and Dollar Tree is up 40%. On the 1-month chart we see that Target is up 7.5% while the S&P 500 is down 8.3%. Dollar General is nearly flat, Costco is down 10%, Amazon is also down 10% and Dollar Tree is nearly flat. So Target is again the winner here. And now that we know the historical stock price performance, it's time to check the fundamentals of this company to see if Target stock is a buy right now based on the fundamentals. Target is a 106 billion market cap company with a PE ratio of just 16 and a forward PE ratio of 15.6, which are both really low in my opinion. These numbers could indicate this company is undervalued, but let's check the other fundamentals first. Companies like Target have a lower profit margin in general, so this is something to keep in mind when evaluating companies like this. Normally, I would say a profit margin of 10% is the bottom, but in this case I will make an exception for these type of companies. Right now, the operating margin is sitting at 8.5% and profit margin is sitting at 6.5%. In this chart, we see that the gross margins and operating margins go up and down a lot, but the net margin is increasing since 2020, which is of course related to the lockdown periods. As I said, I prefer companies with a profit margin above 10%, but in this case I think it's fine. And we will compare it to the major competitors in the end of this video, so make sure to watch until the end. Return on assets is sitting at almost 11%, return on equity is sitting at 50%, which are both fine in my opinion. The 12 trailing month revenue is sitting at 106 billion, which is ironically also the market cap. The quarterly revenue growth year over year is sitting at 9.4%, which is fine by me. When we check the revenue growth of Target over the past years, we see that it has gone up and down a lot. But since 2018 it's growing nice and steady again, and since 2020 the revenue skyrocketed because of the lockdown periods of course. I don't think the revenue will grow in the same amount in the coming years, so that's something to keep in mind. Next up is the balance sheet. Right now, Target has a total cash of 6 billion and an operating cash flow of 8.6 billion and a leverage-free cash flow of 3.9 billion. For me, it's very important that this number is growing every year because free cash flow is used to pay down debt, buy back shares, pay dividends, do acquisitions and all other things. In this chart we see that free cash flow is growing, but it's not really consistent. So that's something I would like to see at a steadier pace, but it's nothing to worry about for now. As I said a second ago, free cash flow is also used to pay down debt, and right now Target has a total debt of 16 billion. So they are capable to pay down a big chunk of the total debt with the free cash flow, which has comforted me a lot. Another thing I like about Target are the share buybacks. In this chart we see that Target is buying back a lot of shares. In the past 5 years, almost 40%, which is really good in my opinion, and this adds a lot of value to the investor. By buying back shares, the EPS will go up when the earnings are the same, which attracts a lot of investors and will increase the stock price. Next to that, the dividends are more easier to maintain and to increase, which is also a great thing. When we check the dividends paid, we see that it's growing at a slow pace, but that's not because of issuing new shares, but because of increasing the dividends itself. And since we're talking about dividends anyway, let's check the dividend scorecard. Target pays a 1.6 dividend yield at an annual payout of $3.6 a share. The payout ratio is only sitting at 23%, which is very low. But the 5-year growth rate is also very low, sitting at 7.4%. Target did increase the dividends for 53 years in a row, which is really impressive. Personally, I would love to see the 5-year growth rate just a little bit higher at 10, maybe 15%. And with the payout ratio being this low, I think this could be easily managed. The last thing I want to talk about are the fundamentals of Target versus the competitors. In this case, I decided to include Dollar General, ticker symbol DG, Dollar Tree, ticker symbol DLTR, and Costco, ticker symbol COST. When checking the valuation of these companies, we see that the PE ratio is the lowest at Target, and it's the same story with the price to free cash flow. So for me, Target is definitely the winner here. Target has the highest revenue growth year over year together with Costco, and it's the same story with the revenue compound annual growth rate. The net income compound annual growth rate is also the highest at Target. And last but not least, the leverage-free cash flow compound annual growth rate is again the highest with Target. So for me, Target is definitely the winner here. Gross margins are pretty much the same at all companies except for Costco. Net income margins is the same story. Return on equity, return on assets and return on total capital are all the highest at Target. So again, Target stock is the winner here. When we check the balance sheet, we see that all companies have a high debt, but only Target and Costco are capable of paying down a big chunk of their total debt. The last thing I want to check are the dividends. Target pays the highest dividend yield, but the other companies do have a higher dividend compound annual growth rate, so not sure if there's any winner here. My final conclusion is that Target is a really nice company which is growing a lot since the lockdown periods. With the current valuations, Target is a buy for me. Right now I don't own any shares of Target, but I will definitely add some shares this week to my portfolio. They are undervalued in my opinion based on the PE ratio. They pay a solid dividend and you have beaten the S&P 500 big time in the past 5 years. That doesn't give you any guarantees in the future, but I think Target stock could be a defensive play as well. Especially during volatile times like this, it's nice to own stocks that aren't going down as much. So for now, I will put Target stock on my buy list. But remember to always do your own research and never fully trust on what I or other YouTubers say about stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.